this table, presentation to donors. And this goes back to our example from the course of the organization which deals with addiction rehabilitation. So what is the purpose of this table? This is a very important table that basically gives us, you can say that if the economic map gives us the economic relationship between the different programs and what happens if we have to close or whatever, this table is like the fundraising map. Okay, so how we present, what we can present and what we cannot present, and you will see we'll have different versions, so you will see how that is used. So let's see what we have here. Basically, this is a table that uses everything that we have calculated until now. The first part is income. So we go to each program and we look at the income of the program. Now, just to show you where the data are from. So this is basically taken from our economic map. So let's look at program A, 4,064. So if we go to the worksheet of economic map, see, this is the figure and broken down according to sources: government, fees for services, donors, etc. Okay? So let's go back to full costing. So this is exactly a copy of the income structure of the organization and the total income. Then we have the line here, which is the full cost. The full cost we have just calculated based on the methods that we have seen. We did all the technique and we have the full cost of each program. Okay, so this full cost is what we have calculated 3 weeks ago when we worked on this example. So this is the full cost, and we can see that we have the total cost of the organization, or the total expenses of the organization are exactly 11 million. And now we want to see the difference between the income and the full cost, which is this line. Okay, now, although it says here presentation to donors, this is not a table that we present to donors, but this is the table that we use to decide what to present to each donor, because by definition, buyers, funding agency or donors that are buyers, they are not interested in the entire organization. They are interested only in the program that they fund. So for donors for program A, I will present income and expenses. Program B, program C, etc. Okay, obviously I don't have to, this is a tool for me, shows me what I can present to each donor. And sometimes there is an advantage. If somebody is not interested in what happens in the organization, I don't have to present the data that may help or may not help. So what do we see here? First of all, we see that all the programs, apart from program C, have negative deficits, which from the fundraising perspective is very, very good, because it means that I can ask for more money. And again, I want to show you that when we looked at the economic map, if you take, for example, program A and program B, which they both show deficit, in the economic map, they were both subsidizing. Okay? So again, the difference between a deficit and economic contribution. That's important to remember. But there is something here which looks in a way a little bit unreasonable. Okay? If we go back to the economic map of this organization, we can see that overall, if we look at the total income compared to the total expenses, we can see that the budget of this organization was planned with a built-in surplus of 604,000. And now I'm showing you a table here, and apart from one program, all the programs are in deficit. So how come a budget which shows surplus, if you break it down to programs, they are all in deficit? How did we get to that situation? And the key issue here is how we relate to the unrestricted income. Because when we look at the income of each program, we did not count on purpose the unrestricted income. If you recall, I think I told you at the beginning that there is a practice to allocate the unrestricted income to the different programs, and I told you that I will show you why this practice is not good, is not to the benefit of the organization. So if I will allocate the unrestricted income to the different programs, the deficit will disappear. But I don't want the deficit to disappear. I want to show a deficit. Now, moreover, it sounds like I'm bluffing here, but this is not the case, and I will explain why. When we finish this part, I will start talking about financial stability of organizations. How do we reach financial stability? Now, the analysis will be very complicated, but the answer is very simple. In order to be stable, organizations, like individuals, they need to have savings. Okay? If you think of yourselves and ask yourself, how do you prepare yourself to future economic disruptions, like suppose you lose your job or something happens and you don't have any income. Now, the most common way, and most probably the only way to do that, is that you have a certain amount of savings, that if you lose your job and you don't have income, you can leave off your savings for a certain period until you get a new job. Okay? If there is no safety net, if there is no unemployment, whatever, you have to rely on your savings. Now, organizations are the same. The only difference is that if for individuals there are certain safety nets, like Social Security, there is no safety net for organization. If you don't have money, then it's your problem. So the only way for organizations, for non-profits, to gain financial stability is to create a certain amount of savings that will be used for rainy days. Now, here comes the questions. How a non-profit can create savings when it is expected to spend all the money that it receives? I mean, when somebody gives you money for a program, that person, that donor, expects you to spend that amount, not to save from that amount, correct? This is the anticipation. So the only source that can be used to create saving is, without obviously bluffing your donors, is the unrestricted funds. Because the unrestricted are given to the organization to be used at its own discretion. And one of the things the organization needs to do is to create that safety net, these savings. So the unrestricted, in a perfect world in which I have only buyers, and I have buyers for my programs, and I have unrestricted, I would like to dedicate this amount fully to create my saving and to fund all my programs from the buyers. Now, this presentation to donors shows us what needs to happen in order for that to happen. So what needs to happen is that I have to raise these amounts for each one of the programs so that each program will be balanced fully. Income equals full cost. And then the full amount of the unrestricted can go to savings. Okay? Now, this is what I would like. This is the situation that I want to happen. What happens in reality is that since my programs are in deficit, I have to use part of my unrestricted to cover these deficits. So if you look at this presentation, you can see that the total income for all the programs is 10,274,000. Total expenses of the program is, the full cost is 11. So I have a deficit of 735,000. Now, in addition to that, I have unrestricted fund of 1.339. So that is divided. Part goes to cover this deficit, and part can be used as savings. But the ideal situation will be that this will be zero, and I can use the entire unrestricted to save. So obviously this is not something that I'm going to share with my donors, but for me as a person who wants to not only to fundraise, but to look at the well-being of the organization, I would like to achieve a situation in which I can cover the full cost of each program from buyers. And this is why this table shows us what needs to be done in order to do that. Okay? And this is again the reason why we can show deficits while we have income which is higher than expenses. Yes, Anton.
This holds true, or will be good to donors if they don't request your financial statements. If they'll ask for your financial statements, then your financial statements will show reserves, and you have to have an internal policy approved and shared with donors, right?
Right. Well, okay. So let me answer that. The question is simple. The answer is more complicated. First of all, you assume that donors can read your financial statements. I can tell you from experience, not always the case. However, and this is a point which is valid. All the donors that I'm familiar with, and some of them even consulted me about this issue, want to give money to a stable organization. How do you measure stability of organization? We'll talk about that when we talk about financial statement, but eventually you need to have an internal reserve. So donors want organization with internal reserve. It's not that they are looking for organization with deficits in their net assets. These are risky organizations. So even if you present your financial statement and you show that you have internal reserve, that can be used as a point to your benefit to tell the donor, look, you are funding my program, but you have to know that I am stable enough. Even if I have disruptions in my income from other donors, your money will not be wasted, okay? So the reserves in the financial statements are not necessarily to our disadvantage. It depends how you present that, okay? And in fundraising, presentation is, we need to learn how to use our financial data to make this presentation, to make the case. And the case here is very valid, okay? The case here is very valid. Of course, it has a certain range. In Israel, for example, if your reserves are above your total income, then the registrar here will start questioning whether you are a non-profit or not. But if you take the American example, in the United States, they don't have these limitations. And the organization that I worked 10 years ago, 12 years ago, the JDC, had internal reserves of $400 million. And it was the most successful fundraising organization that I'm familiar with. It was able to raise $400 million each year from different donors. So it is not necessarily the fact that you have reserve that will affect that. What we need to be able to present, we don't have to present the unrestricted funds or income to our donors. That is the advantage of buyers. Buyers are not interested in the organization. A donor for program A will ask for the budget for program A and maybe the entire budget of the organization. So for the budget, you can present only the expenses. You don't have to present your entire income. And for program A, you present this one. Now, if a year later, or a year and a half later, this donor will take your financial statement, will do an analysis, which we'll see later on, we'll say, well, you made a lot of money. That's a risk that you can take. That hardly happens, okay? But again, from our point of view, from our internal point of view, assuming that we don't have such huge reserves, and that is the case with most non-profits that I'm familiar with have the opposite problem. They have negative working capital and negative, so they are not in the situation that they have reserve. If we want to create this reserve, we need to dedicate the unrestricted for reserve and present the budget to donors in this way. But what I've presented here is an ideal situation in which I have this presentation and I come to my donors and I present the full cost and I want to raise or fundraise the difference. But the real world is a little bit more complicated, as this document will present, because in many cases, I would say in most cases, donors have different demands and different restrictions. For example, a donor will say, I don't want to fund general and management. You entered in the full cost. We cannot hide that. So we entered in our full cost calculation here 824,000 shekels for the part of the management. I don't want to fund it. Why should I fund the salary of the fundraiser or of CEO? So donors put restrictions. And what I will show you next class is how we deal with how the presentation to donors, the table of presentation to donors changes when we have donors restriction. We have here one thing that I haven't mentioned yet, and that is what happens here. This is a tough cookie, as we say. This is a program with a significant amount from donations, and it has a surplus. Now, a surplus is not something that we want to present or we can present when we want to fundraise, because who will donate money to a program that is actually making money? Okay, that's a big issue. So when we look at this table of presentation to donors, one of the points that is here in the list of points, okay, what we should present to our donors, one of the points is what happens when we have, sorry, not this one, what happens when we have a surplus? This is kind of end game for fundraising. I mean, how can you raise money to a program that makes money?
But it's a good thing to keep the success story here to show that if you give us money to cover the other deficits, then we have potential to,
Yes, Margot, but look at this program. The sources are donations and fees for services. Altogether, 1.36. For that specific program, let's say that you are the donor, but you are a buyer. You're interested only in program C. You don't care what happens in the rest of the organization. That's exactly the point, that when we deal with buyers care only on a specific program that they fund. They don't care about what happens in there. They don't care about A, B, D, and E. They care only about this program. And in this program, we raise 819,000 from donors, but we show a surplus of 449. And the question that the donor will ask is, this money, how do you use it? I mean, your expenses for this program are only 914, even including the general management and everything. There's no...
I think it's apart from the fees of services, then it's yours to do whatever you want. But if it's the other one, donations, you need to give it back.
Right. So here we are on the border of finance and ethics. Okay? So I'm not giving a course in ethics, but I can tell you what organizations do. You have to decide. You have your own moral principles, so you have to decide. One thing is, as Motas has said correctly, if the program is a profit, you have to give it back. I mean, you have to come to the donor and say, honestly, I don't need money for this program because I have enough fees for services that cover this program. Sometimes organizations forget their ethical principles and they don't actually do that with donors. So apart from being honest, the only option here, and again, it's a bit dishonesty, but organizations do that sometimes, they will hide the fees for services for this program. Basically, they will not show it as income for that program, but will move it to here, to the unrestricted. Now, it's very difficult, when you go to the accounting of the organization, it's very difficult to know if you have fees for services, like individual X gave money for Y. When you look at the accounting system, you will see amount and the name of the person. There is usually no indication, unless the organization wants to have an indication. There will not be an indication that these fees were for specific program. So I'm guessing, again, I don't know exactly how this organization solved this problem, but I'm guessing that they didn't show this income as part of the income of program C, and in that way they were able to fundraise for this. If you exclude that, obviously you have expenses of 914, income from donation of 818, and then it's okay. Yes, Marwa, and then on top.
No, I was going to say it really depends on the type of organization. There's no right or wrong, and there's no one or two scenarios. In my relevant organizations, it also depends on the type of relationship you have with the donor. If it's an open, good, honest relationship, you inform the donor that you might need to shift this amount to another program to cover other. And it's a long process until you reach this trust with the donor. It takes years and years. And by moving it or hiding it, I'm not saying it's wrong, but there's no right or wrong. It depends on the...
Well, look, here again, when we move to the ethical part, we have opinions. We don't deal with facts. I would argue that there is right and wrong, but different organizations put the borders in different ways. My point of view, dealing with such issues is the following. And again, I'm not enforcing it on you, but this is the way I've been working for the last 24 years. Is don't lie, but if there are certain facts that are not in your favor and you are not asked about them, you don't have to voluntarily give them away. Okay, that was my, I would say, ethical compromise in these questions. But I would say that taking these fees for services and put them out, it's, in my standards, on the verge of being a liar. Okay, but again, everybody puts their right or wrong in different places. I'm not judging. I'm just, the beauty of this table that it puts the problem on the surface. Now, whatever you decide to do in your professional life, that's up to you. But at least when we look at the numbers, we know exactly where we are. Antoni wanted to add or ask?
I think being creative also will answer the question. Like if you think of capital expenditures or a growth of that program, then you convince the funder.
You're a finance person, right? So there is a very famous book which is called Conspiracy of Fools. It was written by a famous reporter in the New York Times about the issue of Enron, the American company that used creative accounting to fool their investors for more than 10 years, and eventually the CFO went to jail. So when you talk about finance and creative, you have to be very careful. It can lead you to jail. Anyway, look, obviously, if the donor is fully informed that this is the situation and agrees to that, then there is no deceit here. All the information is on the table.
I meant my creativity is not playing with the figures.
I'm just kidding about
creative ideas
correct.
within the program.
But eventually, what is important here is to understand that when we do this donor presentation and we see a case like that, that should be a red flashlight. Here, there might be a problem. Now, you as directors, fundraiser, whatever, you have to decide what you want to do. But it shows you, it is funny that in the business world, when we have a profit, it's a good thing. In the fundraising world, it's a bad thing. So when we have a positive number, that is a sign of warning. You have to decide what you want to do. Now, I've just put the ethical issues on the surface. I'm not a judge, and I'm not telling you what you should do, but you should know that here you may have a problem. So now let's go to our main issue, and that is how this is presented to donors and what the effect of the restrictions of the donors on our presentation, our ability to raise additional funds. So I've marked in yellow the two programs that had changed, program C and program F. Okay? All the rest, A, B, D, and E, we basically use the same method. We take the income from the income part, we take the full cost based on our previous calculation, and we calculate the deficit or surplus in case there is a surplus. The issues, the restrictions are in these two programs. So let's start with program C. Program C, I have an agreement with the donor that the cost of the program will not exceed the cost, the direct cost of the program will not exceed the donation. The rest, the fees for services, the donor doesn't care. But I cannot present cost which is higher than the 742 because I cannot come to other donors and tell them, give me money, but it's purely for overhead. To remind you, the direct cost of the program is 742. Now, I can add overhead if I raise money for the entire program, but if my entire direct cost is covered, it is not feasible to come to somebody and tell these donors, give me more money because I need to cover my overhead. That never happens. So basically, I am restricted here to present a cost which is exactly based on my agreement with that donor, 742,000. Okay? And then my fees for services are kind of a surplus with here in this plot, in this story, with agreement of the donor, but I cannot present different numbers here. So this is restriction number one. Okay? Now here in program F, again, I have an agreement with the donor that the program will cost 506,000, including infrastructure. That is the 10%. Okay? So I have to present to these donors 506,000 and no deficit. Okay, again, this is, I received a donation for this program under these conditions, that this will be the cost of the program. And this is exactly what we mean by donors' restrictions. When we have different grants with different restrictions in the grants, these restrictions basically impose on our ability to approach other donors, because donors, they speak with each other. They always ask you to show who else is giving you money. And if you agreed with the donor that this is the cost of the program, this is the cost that I have to present. And I cannot present to one donor cost A and to other donor cost B. That does not work so well. Okay? So basically, instead of presenting here the full cost of each of these programs, I have to present these numbers that were dictated to me based on my agreement with these donors. So what happened? What happens is that when I look at my total income and compare it to my total expenses, the total expenses, which is the sum of all the presentation to the different donors, is 11.2. But my actual expenses is 11.5 almost. The actual expenses, you can see it here, or you can see it also in the economic map here. Okay? So there is a difference between the total amount which I am able to raise, okay, which is the sum of all these figures, and my actual total cost. Okay? All right, I can raise this plus this plus this plus this, and that's all. I cannot raise here any more money, and I cannot raise here any more money. So there is a difference between the total amount that I can raise and my actual cost. And that difference is exactly here. Gap due to partial allocation is the difference between my actual expenses and the expenses that are the result of my presentation to donors, which includes the two restrictions. Okay? And therefore, when I look at the surplus, which is the result of my income minus the expenses that I show to donors, the surplus is 475. My actual surplus is much lower, 239. And again, the difference is exactly this gap. The implication is that even if the organization will succeed to raise funds based on this table, will succeed to raise this amount for program A and this amount for program B and these amounts to programs D and E, even if it succeeds to do that, it will not be enough to cover all the expenses of the organization. There will be a gap due to the way costs are allocated as a result of donors' restrictions. And that is a point that they presented in the article of the bond organization, but I think they don't emphasize enough the problem that it creates to the organizations. The restriction of donors create lack of ability to raise the entire amount that the organization needs. Okay, this is something which is very important to understand. Now, it's not that we can do something about it, but we have to be aware of that due to these restrictions, we have less ability to use unrestricted funds in order to create saving. Okay, our ability to create saving diminishes due to these donors' restrictions. Okay? Questions? All right, hopefully it will be clearer once you do it in the exercise. In exercise number 2, there is an example of donors' restriction, and once you do that, I hope it will be clearer. Okay? But the main point is that when we have restrictions, when donors come and say, well, we don't care what your cost structure, we are willing to pay X or Y or whatever, at the end result for the organization is difficulties in its fundraising effort. Okay, it is kind of stick in the wheels. Okay. All right. So we are all clear until now, right? I don't know what the silence means, but but I want to assume that it's okay.
Sorry, can I ask? So you said for the next year, the donor from program C said to only cover the expenses.
Direct.
So the direct expenses. So the surplus will not be in the previous year. What kind of implication has that? Because this is like the only program which actually creates a lot of surplus?
No, well, the implication is, if you look at the presentation to donors in the previous case, we have a full cost of 914. And if you put aside the fees for services, here we said that it creates a problem, but let's say that the organization hid that. It's not here, they just put it somewhere else. They can try to raise 914,000, okay? While in this scenario, they are restricted. They cannot raise above this amount because this is what they presented to the donor or donors as the cost of the program. And basically, they kind of locked themselves in that agreement because they cannot come to other donors and tell them, look, this is my direct cost of the program, please give me money for the overhead allocation. This theoretically may be possible, but practically it doesn't work. Okay, it doesn't work. You come to a donor and said, my full cost of the program are covered, but I don't have enough money for overhead, so please give me more money. That will not work in real life. Okay? And here, this is the restriction. And here the restriction is that the donor, instead of looking on what is the actual full cost of the program, which as you can see is 593, the donor basically limits the amount that they are willing to accept to 506, which is an arbitrary 10% above the direct variable. And these two differences between the full cost of the program and what we can present, they create the gap. Okay? You can calculate the gap also by calculating the differences between these restricted expenses for presentation and the actual full cost. It will come up to the same number. Okay? So these restrictions basically create obstacles for the organization to fully fund its program from designated income.